Rohit, great to have you back on. Want to get your thoughts on some of these comments that we did get from Zuckerberg this week, especially given the fact that he has been starting to rein in some of the costs, albeit perhaps still modestly.
Hey, thanks for having me. And again, I think reining in costs is of paramount investor importance right now. Again, there is no line of sight of when we get those returns on $15 to $20 billion that they're spending on metaverse. So if that's the case, investors need some return on those, and reining those costs in, probably reining them even more from what they are doing right now, it would drive the stock higher from these levels.
So why do you think, in general, why do you think Meta is a buy? I mean, it had such a rotten year. And Wall Street in general has continued to be pretty steadfast in its bullishness on the name. What propels it now, finally?
There's a bunch of factors that are still going up against, and they are slowly ebbing, in my opinion. You have the Apple effect, you have the TikTok market share effect, and then you also have effect of things such as kind of what they're doing with some of the Reels monetization. So I think some of the factors are turning from headwinds into neutrals, and some of the new revenue generation things that they're doing will start becoming more and more material, in my opinion. So I feel at the current levels, the expectations are a wash. Investors do not expect big heroic things from here on out for the stock to work. So a little bit of cost savings and a little bit of revenue stabilization should help the stock grind higher as the year progresses. So that's where low expectations, low investor sentiment, a lot of fear as well as hatred in the stock. So we like it here simply because it can't get any more worse from here.
Can we quantify at all the seeming market share improvement for Reels relative to TikTok from an advertiser perspective at this point? It just seems as if at this point there's been a little more uptake on users.
I think users, stability in users and improvement in engagement, which we see is happening with Reels, will drive monetization. I think they're just still very, very early. When they talk about less than $10 billion in ARR, Reels is probably more than 10% in engagement, but probably less than 3 to 4% in revenues. So there is a very big gap. We don't see that gap narrow anytime in the foreseeable future. Probably it takes another 12 to 24 months, but the gaps starts to narrow over the next 3, 6, 9, 12 months as the company starts to crank up the monetization engine. And we have confidence in them doing that. On the other hand, I think the Apple factor, which was even a bigger factor in my opinion, will start to fade in a way that A, we have the lapping effect from what happened in 21 into 22 and 23. And B, I think all their investments in ad targeting will start to have a little bit of tailwind. So we don't want a lot of heroic things, as I said, just a little bit of incremental improvements. And yes, more cost cutting in metaverse will drive the stock, in my opinion.
Okay. Rohit Kulkarni, thank you for joining us.
Okay, thank you.